That includes our next guest, Shanna Sissel, President and CEO of Banríon Capital Management, joining us, I believe, from Chicago via Zoom. Shanna, thanks so much for joining us here. How are you kind of viewing this market activity we've seen over the last several weeks? And how do you what kind of conversations do you have with your clients about these markets?
So you guys have me on here regularly, and you know that I've kind of been anticipating that there would be something like this happening. In fact, I've often commented that the straight up movement of the market didn't necessarily make sense to me. I think having sell-offs and downturns are healthy things that markets need to stay in some balance and not get overheated. So a sell-off like this is to be expected. We haven't seen one in almost 5 years at this point, and to that extent, I actually think this is a great buying opportunity. Now, that said, there is some economic data that has been a little weak. And that is more cause for concern, because that could suggest that this could be a prolonged downturn. And if that's the case, it may be warranted and makes sense to maybe sit on the sidelines a little bit and kind of let that go through the cycle and then kind of dip your toe back into the markets.
So you mentioned, where does it make sense to buy the dip, and what is that time horizon then? As in, like, you don't want to do it for a quick trade, clearly.
Right. So, you know, a lot of discussion has been had about certain factors of the market and sort of the transition from the momentum and growth names into the value names and this rotation that's going on. Also from domestic to international, as international stocks have done better. And that is causing a lot of transition in the market. And then once we kind of get through that rotation, it's a better time to kind of start to look at the factor performance and kind of take your bets. With that in mind, I invest based on long-term trends and things that I think will win in the long term. And so I look at opportunities like what's going on and see names like NVIDIA and some of the larger tech names sell off very hard and come down to multiples that we may never see again, particularly NVIDIA coming down to a multiple it hasn't seen in decades. And for those reasons, I'd be looking at some of those names to position in my portfolio, but I would be cognizant of the fact that value factors are starting to work. These tend to be cyclical trends where you see, 10 years where one factor outperforms another. An example of that is going into the financial crisis. We had a long period where value stocks did better than growth. And it's since then that growth stocks have really taken off. And so I think you want to be looking at some of the names that have been overlooked. Financials and healthcare tend to do well in a stagflation environment, which is a real risk right now.
Shanna, I know you have a lot of experience in alternative investments, private equity, private credit, hedge funds. Mm-hmm. When you see volatility in the public markets like we've seen over the last several weeks, how does that impact the private side?
Well, on paper, it doesn't. As Cliff Asness likes to call it, volatility laundering. They don't have to mark to market. So you don't actually see volatility come through in the private markets in a visual way. But that doesn't mean that if they had to mark to market that they wouldn't see the same kind of downturn. Just from a behavioral finance perspective, clients don't have that in front of them all the time to make knee-jerk reactions, and that can be a good thing. The private markets tend to be just as damaged by these types of things as well, but they also tend to be the place where you can get your outsized returns as the market turns down. Things like distressed debt always are strong coming out of a market downturn and economic weakness. Private equity is usually not a good place to play until rates come down, but private credit can be really attractive as the banks tend to tighten their credit standards in softening economic conditions. And then if you want more liquid options as ways to provide a hedge for your portfolio, one of the ETFs we've talked about in the past that has shown exactly why you'd want to own it is BTAL, which is the anti-beta fund by AGF Investments. It's long, low beta names and short, high beta names. And that ETF in particular has done really well recently as volatility has increased. And if you are thinking that volatility is going to increase, the two areas in the more liquid markets that you can get ETF exposure are going to be things like that, but also anything that uses option volatility as part of their investment strategy. So like a MRSK or something to that extent would probably benefit as well.
All right, Shana, thanks a lot. Really appreciate it. Shana Sizzle joining us from Banríon Capital Markets. All right, let's go to the housing market. Looky here, mortgage rates dropping for a 6th straight week.
Yes.
Lowest since December. I want to get a check in here.